All right, let's dive right into this explainer. Our mission today is to demystify the balance sheet. But more specifically, we're zeroing in on the accounting equation behind assets that literally holds the whole thing together.
So let's start with a really common question. If a business is pulling in a profit, why can't we just peek at their bank account to figure out what they're worth? I mean, you'd think cash tells the whole story, right? But honestly, a business is rarely that straightforward. Even the most highly profitable companies aren't always getting paid immediately. They're building up inventory, buying buildings and equipment, accumulating assets that just can't be instantly converted into cash. And on the flip side, they usually owe money to suppliers or the tax man. So looking at cash alone, it absolutely doesn't show you a company's true value.
And that brings us to our primary tool, the balance sheet. This is a summary of financial balances, and it's basically the holy grail of financial conditions. People always describe it as a snapshot of a company, and there's a really good reason for that. Unlike an income statement that tracks performance over a whole quarter or year, the balance sheet is completely unique. It only applies to a single specific point in time. It is a frozen snapshot of a specific date, not a timeline of events.
Here's the roadmap for today's explainer. 1. Financial snapshot. 2. Breaking down assets. 3. Liabilities and equity. 4. The equation in action. 5. Keeping balance accurate. And 6. The final balance.
Kicking things off with Section 1, the financial snapshot and the golden accounting equation. Now, this perfectly illustrates the golden rule we're talking about. If you take a company's total assets as a whole, it is perfectly symmetrically split into two halves, liabilities and equity. This is the ultimate scale, and it absolutely must stay balanced at all times. So a company's net worth, its equity, has to equal its total assets minus its liabilities. Put another way, everything a company owns, its assets, was paid for by either borrowing money, the liabilities, or by owners injecting capital, the equity. The accounting equation behind these assets is literally the unbreakable foundation of all financial reporting.
Now you might be sitting there wondering, how on earth does it stay so perfectly balanced in the messy real world? Well, the secret is double entry bookkeeping. This perfect balance between the two halves is actually by construction, not coincidence. Every single time a transaction happens, boom, it's recorded in at least two different accounts. If you buy a shiny new piece of equipment for cash, your equipment assets go up and your cash assets go down. The scale never ever tips.
Moving right along to Section 2, breaking down assets, specifically looking at liquidity and types. Let's focus in on that first side of the scale, what the business actually owns. The accounting equation behind these assets relies heavily on a concept called liquidity. And liquidity really just means how fast something can be turned into cold, hard cash. So assets are always listed by the speed of conversion. On one end, you've got current assets. These mature in less than 1 year. So we're talking cash, accounts receivable, which is just money customers owe you right now, and your inventory. Contrasting that on the other end, you have long-term or non-current assets. These take way longer than a year to mature. Think massive real estate holdings or heavy machinery. Now, for public business entities, international accounting standards have some very strict rules on these long-term asset categories. Let's just fire through this list real quick. You have the standard stuff, property, plant, and equipment. Then there's investment property like real estate. We also see intangible assets. These are things you can't physically touch, like patents, copyrights, and goodwill. But honestly, the wildest category on here has to be biological assets. Literally, living plants and animals count as corporate assets. No joke. If a company raises sheep for wool or has orchards to harvest apples, those living, breathing organisms are officially tracked and valued on the balance sheet as biological assets. How crazy is that?
All right, shifting gears to Section 3, liabilities and equity, exploring what you owe.
So, we pivot to the other side of our balanced scale, what you owe and what's left over. And just like we saw with assets, liabilities are stacked by immediacy. First up, current liabilities. This is the stuff that needs to be paid immediately, well, within the year at least. Think accounts payable to your suppliers. Then we contrast that with non-current liabilities. This is the heavy, long-term debt, deferred taxes, big corporate bonds, or a 30-year commercial mortgage.
And that brings us to the final piece of the puzzle, shareholders' equity. Now, formally, this is actually treated as a part of the company's liabilities, which sounds weird, right? But it's because it represents the funds that are theoretically owed back to the shareholders. It's considered a residual amount. Basically, if you were to take all those assets we just talked about, sell them all off, and pay down every single liability, whatever cash is left over, that's the equity. It's the true net worth of the company.
But as you can imagine, reporting this isn't just slapping a giant number at the bottom of a spreadsheet. Take a look at the massive amount of disclosure required just in the equity section for public companies. You've got to list the number of shares authorized and issued, the par value of those shares, a full reconciliation of outstanding shares, descriptions of shareholder rights and restrictions, treasury shares, even shares reserved for options. The sheer complexity required here to maintain total market transparency is absolutely staggering.
Let's put this into practice. Section 4. The equation in action with a small business sample.
Okay, let's bring all this dense corporate jargon back down to earth and actually see this equation functioning in the real world with a simple small business. Check this out. On the asset side, this business has $12,800 in cash and accounts receivable plus $25,000 in fixed assets, tools, equipment, that kind of thing. That gives us total assets of $37,800. Now, remember the golden rule. The other side absolutely has to match, so let's check the math. They have $30,000 in liabilities, notes and accounts payable, and $7,800 in owner's equity. So what's $30,000 plus $7,800? Boom! Exactly $37,800. The equation works flawlessly. Total assets perfectly match the liabilities plus the equity.
Which brings us to Section 5. Keeping balance accurate and ensuring truth. So you might be asking, how do massive global corporations actually prove that these numbers aren't just completely made up out of thin air? Well, they use a grueling process called balance sheet substantiation. This is the rigorous accounting process used to confirm that the balances held in the primary system of record perfectly match all the supporting subsystems. It's essentially an intense top-to-bottom fact-checking mission for the entire accounting equation. This ensures the snapshot remains trustworthy and completely compliant with super strict regulations, like the SOX 404 top-down risk assessment.
And of course, this substantiation doesn't just happen by magic. It breaks down into 3 distinct steps. Step 1 is reconciliation, basically auditing things at the transaction or balance level. Step 2 is the review, checking all the pertinent supporting documentation to prove everything is real. And Step 3 is certification, a formal sign-off driven by corporate policy. Historically, this was a total manual nightmare driven by endless spreadsheets and lost emails. But thankfully, in recent years, companies have been rapidly moving to automated software solutions. This handles the massive volumes of accounts, drastically improves transparency, and seriously reduces their risk.
Finally, let's wrap up with Section 6, the final balance and your personal finances.
I want to bring this explainer home by connecting these grand corporate financial structures directly to your everyday life. Believe it or not, this exact same accounting equation applies to your own personal finances. Think about it. Your personal net worth is simply your total assets, like cash in your checking account or the market value of your home, minus your total liabilities, which are things like student loans or your mortgage. The underlying math of a multi-billion-dollar global corporation is the exact same math that defines your personal financial health.
We've definitely covered a lot of ground today, seeing exactly how assets, liabilities, and equity perfectly balance out on a single frozen date in time. But I want to leave you with a somewhat provocative question to chew on. If a balance sheet is strictly a snapshot of a company's condition on just one single day of the year, what vital financial secrets might it be hiding about the other 364 days? Seriously, think about it. To see the full movie instead of just a single photograph, you have to look at the other financial statements, which is exactly what we'll be exploring next time. Until then, keep questioning, keep learning, and keep balancing that equation.